Hello again, everybody. Well, employing the two heads are better than one philosophy, which probably I should do more often. I have brought in my partner, Brandon Mallinckrodt, of course, a fellow certified financial planner here at One Private Wealth. Notice we don't bring Tom into these things. Is that
I think
by
this
design,
is our. I think
guess?
this is our thing right now. I think it's just our thing.
It's not his.
No,
No.
but I think he might want to try at some point.
All
So
right.
we'll get him in here.
Yeah,
I don't
we
know
get
if we'll
him.
do 3 seats or just you and him. I don't know how that'll
We'll
work out.
figure it out. Yeah, not his thing, but although we did it early on and he was very comfortable, but inside, just not kind of his thing. Anyway, thank you, folks, for joining us. When we talked to clients like 15 or 20 years ago, what was important for us as financial planners back then, it's interesting, it's a little different now because, yes, we both get a little bit older along with our clients. Certain things that were not important to folks in their 40s and 50s all of a sudden are very, very important now, a couple of decades later. And that's what we're going to address. And we're talking about RMDs. This is acronym day, by the way. Required minimum distributions and qualified charitable distributions, or QCDs. And we need to thank a client for this, don't we?
We do. Our buddy Sam, who, he gets enough publicity as is, so please don't go knocking on his door after this goes viral. But we do want to thank you, Sam, for the idea for this podcast episode.
Yeah, Sam was in for a regular meeting with his wife and said, hey, you guys might want to talk about these RMDs and QCDs. I'm like, why haven't we done that yet? So here we are.
It was a great idea by Sam, and I definitely think that he's going to find this useful for his friends and family, too.
Yeah, great. So let's dig right into it, Brandon. Required minimum distributions. So give us some bullet points on that. Who should even be worried about that? What is it? Take the seat here.
So the required minimum distributions is the amount of money that the government requires you to take out of traditional IRAs on a yearly basis once you reach the age of 73. It used to be 70 and a half. They've adjusted that now to 73. And then in 2033, the level or age is now going to move to 75. So that's something to keep in mind. Also, what the government requires you to take out of your traditional IRA on a yearly basis starts out at about 4% when you do turn age 73. So something to keep in mind for those that are approaching those ages, and something to just keep in mind when you are planning for taxes as well.
And those percentages obviously go up as you age. We like to joke that the government would prefer you not die with a lot of money in your IRA. Now, you'll never drain it. It's kind of impossible, even just with a modicum amount of growth. But yeah, those percentages, you lucky enough to live into your 90s, can really get up there. And that gets into all kinds of tax planning and everything like that. That's important. So let me ask you a question about RMDs, because you and I get this a lot, and that is, when should I take it? Okay, let's say I'm 75 years old and I have to take out $50,000 this year. Do I, in January right away, should I take it out? Should I spread it out over 12 months? Should I wait till the very end? What's some good advice there?
So when you're looking at taking money out of your IRA for your RMDs, if you need it to live on a monthly basis, then we recommend that people set up a strategic amount that comes out every single month to meet that RMD by the end of the year. For those that don't need the funds because they have other mailbox money that's coming in, whether it be Social Security or a pension, historically the market has gone up 60% of the time. So if the averages play out in your favor like they have, you'd be better off waiting to the end of the year to take those funds out. So depending on what your individual circumstance is or your individual outcomes for the year for when you need funds, that does dictate and play into the decision you make for when you should take the money out of the IRA.
But you got to take it out, because the penalty used to be unbelievably egregious. I remember when I got into the business quite some time ago, and it was 50% of whatever you didn't take out, you were penalized. So if you had to take out $20,000, you were penalized 10 grand on top of that. They finally got some common sense, but it's still pretty high.
Yeah, so right now they've set it at 25%, but they've also added in provisions to where it could get down to 10% or even 0, depending on how quickly you rectify the situation. So we tell clients and we work with clients to make sure that they're getting those funds out earlier in the year or strategically throughout the year so we don't run into a problem come the end of the year. We keep track of all of those things so that clients don't have to. But what you don't want to do is get to the end of the year and realize I didn't take out enough money when it comes time for tax season, and then you try to rectify the situation afterwards.
Now, before we get to the QCDs, the Qualified Charitable Distributions, because they can be joined at the hip, this is what we call a good problem to have. Some folks, you play by all the rules. You invest in your 401k IRA as a young worker, and then you get to a point. And I recently did a podcast about this, about having quite a bit of money that you did so well saving and everything, and you've got so much money in these IRAs, and it's like, I'm at RMD age. I have to take out 6 figures because I have so much in the IRAs. I wish I would have employed strategies back in my 50s, even 40s, to make sure this didn't happen. And we're talking about Roth conversions. Give us some bullet points about that.
So when you're thinking about Roth conversions and you're planning out for the future and how much money you're going to have in your IRAs when you do get to required minimum distribution age, what you should be looking at is those different tax brackets that you are currently available for you to take advantage of. If we think about the debt that the government has, and
government has some debt?
I don't know. When did that come
Stop
about?
the presses.
When did that come about?
Yeah.
But taking advantage of those tax brackets that are on the lower end, whether it be the 12% bracket or the 22% bracket, I think paying tax now in those brackets and trying to fill up those brackets with Roth conversions is a great opportunity, because I can't say for certain, but I think pretty certain that tax rates will not be coming down in the future. And so a lot of times people have said, put as much money into your IRAs as possible, take the tax break now while you're working. You'll be making far less in retirement. But as people's assets continue to grow and as their Social Security benefits continue to grow, you might be making more in retirement than what you're making right now. So especially if you're a diligent saver who saves a considerable portion of your take-home income, utilize some of those Roth conversions now, take advantage of the 12% bracket, the 22% bracket, and move some money out of your traditional IRAs into your Roth IRAs. It will benefit you in the long term.
Yeah, this is a very big topic now in the financial planning community and among investors. I think it can be oversold, if that's the right term, because you were kind of hinting on this, that it may not be right for everybody when you look at tax brackets. There are some people that, speaking of the good problem to have, who even in retirement will be in the upper income tax bracket because of some RMDs, because of pension, Social Security. They have enough money in taxable assets where the dividends coming in, and maybe they have some rental, whatever. So you look at it and say, well, should they do Roth conversions necessarily? Then it becomes, well, only if you want your kids to inherit a bunch of tax-free money. Right. But this is where you need to talk to a financial advisor, and everyone should do that. Okay, so now let's go to the thing that I hinted at the beginning, these QCDs, or Qualified Charitable Distributions.
That's right.
It's interesting because the age. You talked about the fact that RMDs, which for years, decades, start at 70 and a half. A few years ago, with some tax reform, it was to 73. It'll eventually get to 75. But the QCD age, for people who could take advantage, never moved up. It stayed at 70 and a half. Tell us about this.
So taking advantage of the QCD, so Qualified Charitable Distributions, that age starting point is still at 70 and a half, which is a great opportunity for those people that have those large IRA balances to be able to remove some of the assets from those IRA accounts before they get to an age where they have forced income on them. And all of the distributions on the required minimum distributions are going to be classified as ordinary income. So it's going to be an ordinary income tax rate on those dollars that you remove. So if you are charitably inclined, it's a great opportunity to start sending money to a charity or to a church or an organization that's a 501c3 that you would have already been doing with after-tax dollars, now with your pre-tax dollars. So you were able to get the tax advantage on the front end, the tax advantage growth, and then send those funds out of your IRA without having to pay tax on them as well.
And it's a pretty large amount if people want to give it.
Yes. So when you're looking at singles, you can give up to $108,000 in QCDs out of your IRA this year. That is indexed for inflation in the future. So for a couple married filing jointly would be able to give $216,000 out of an IRA.
That's right. So if you've got the funds and you're wanting to stunt the growth of the IRA and you're already charitably inclined, to your point, there's quite a bit of a ceiling to be able to do that. It's important to get the timing right on this, right? You can't really go ahead and take your RMD out and then decide after the fact, oh, now I want to do the QCD.
Right. So when you're looking at it, if you were going to process QCDs, so those qualified charitable distributions, you want to process those first. And the reason I say that is because those dollars count towards your RMD balance for the year.
Yes.
So if you take out the qualified charitable distributions at the beginning, let's say that your RMD amount was $50,000 and you did $50,000 worth of qualified charitable distributions, that would cover your RMD balance for the year. You would not be forced to take out any other funds from your IRA if you did not need to. The other side of the coin with that is if you took out $50,000 to start and you were going to use those funds to live on and then decided to take out the QCDs, well, now you've taken out $100,000, still 50 of it's not going to be taxed, but you did have to pay $50,000 worth of taxes in ordinary income on that original RMD distribution.
Right. Brandon, we have a variety of people who watch the podcast, some who work with advisors, some do-it-yourself investors. Yes. So for people watching who are interested in maybe employing QCDs for the first time, they're of age, they want to get this right with the RMD, tell us how administratively or mechanically you do this to get basically money from the IRA to the charity.
So when you are working with your custodian, wherever your IRA is held, you have three different options. You can have the custodian issue a check directly to the charity. So that's one option. The other option is for the custodian to send you a check in the name of the charity if you're someone who wants to hand deliver those checks to the charity.
Notice what Brandon just said. The check needs to be made out to the charity, not to you personally. So if you get the check, make sure that's the way it's written out.
And then the third option is for the custodian to issue you a checkbook, which then you can write a check directly to the charity as well. So for those people that like to drop off a personal check, that's an option as well.
And Brandon, I really like that third option, and we have a number of clients who do that, where people who are charitably inclined and may not make one big gift to one charity, but either to one charity, maybe a monthly one to their church.
Correct.
Or have I have 10 or 15 different charities and I just do little ones. Checkbook is great. That didn't exist years ago. It just the legalities of that didn't allow it, but it does now. It works very, very well.
Yeah, and I think the best thing to keep in mind too is a lot of times people want to wait till the Christmas season to be able to write a check to a charity or their church. But those checks do need to be posted to the account by 12/31. So keep that in mind. I think any charity would love to get your money earlier in the year. So maybe Christmas in July, if you want to do that, write your checks earlier. But just don't wait to the last minute, because you don't want to run into a situation where the charity gets so busy and swamped at the end of the year that they are unable to cash your check.
Great advice. So as always, talk to your CPA on the tax side of things. Talk to your financial advisor if you need more information about that. Or, as always, you can just go into the comment lines down here and say, yeah, Dave, Brandon, I have a question about that. And we'll engage with you and answer that. So, my friend, thanks for joining us. And by the way, happy anniversary, my friend.
Right back at you, too. 1 year here at One Private Wealth.
How about that? We found our freedom about a year ago, and here I notice you have a little bit more gray in the past year.
A little bit more right here on the side. But, it's all in good haste, or it's all in good efforts here as we're working for our clients and putting in the effort here at One Private Wealth.
Yeah, appreciate it, my man.
Sounds
all
good.
right. Thanks, everybody. Again, if you haven't done so, hit subscribe. And if you know people who could really benefit from the information regarding RMDs, QCDs, Roth conversions, pass this along. And like I said before, don't hesitate to ask any questions. We'll help you with that. Take care. I'll talk to you again next week.